In this session, we are going to get into understanding the concepts of return, primarily the various definitions which can be attributable to the concept of return, and slowly moving into the world of differentiating between the required rate of return and expected rate of return. How do we use all these concepts as a part of the typical valuation process? So this is the typical process which we are going to follow, and more importantly, the reason why we look at the concept of return is it plays a very important role in the equity valuation process. How do I find out what is the return this particular security would be giving when I am investing in it today? Or based on the return, how do I assess how much should be invested to purchase the share of this particular company? All these things, they get driven internally. The equity valuation process is dependent heavily on the concept of return. So that's where we are trying to understand the various mechanisms which can be used to compute the returns and the various dimensions from which the return is typically defined. So with that as the base, let's get into it. So when we talk about the return, we use different definitions, starting with a holding period return. So let's say I have I have purchased a security long back at some P naught, and today the price of it has become P1. I don't know how much time has passed between this and this. Some time back I have purchased the security at P naught. Today the price of it is P1, but in the meanwhile this security has given me some kind of benefits, and let's say that benefit during this period is what is D1. So overall, at the end of this period, whatever is the period, at the end of this period, what is my return? I have got D1 during this period. Along with that, there is a change in price from P0 to P1. So the benefit which I have got is D1, and at the same time P1 minus P0. Express that in a percentage form. That is what I call as a holding period return. This holding period could be 1 month, 1 year, 10 years. We are not that much bothered about it. The day on which I have purchased the security, the day on which I have sold the security. Whatever is the change in price, and whatever the benefit that that particular security has given during the holding period. So holding period is right from the time period of buying to selling, nothing to do with 1 month or 1 week or 1 year or 10 years. Whatever is the time period we are holding the security. So whatever the benefits that we have received during that period represented by D1, and whatever is the change in price during the period represented by P1 minus P0. That is the overall return, and I divide it as a percentage of my purchased price. I call that as the holding period return. But in this, we need to understand that whatever the benefit that I am getting during the period, it is assumed that this particular benefit is coming towards the end of the year. Means at the time of selling of itself. But if I am getting it somewhere in the middle, right? If the D1 is not coming here, but it is coming here, this is the day on which I have purchased at P0. This is the day I am selling it at P1. The formula is assuming that D1 as a cash flow is coming on this day. But if D1 is a cash flow somewhere in between, it is said that try finding out a modified D1 as of this date by including the interest for this period. Find out the interest for that period on D1. So probably call it as D1 star and then use it as a part of your return computation. That is what we call as the holding period return, where I am assuming that all cash flows are coming at the end of the holding period. If there is any change in the flow of the cash before the holding period, before the completion of the holding period, you can simply add the interest up to the holding period and update the intermediate cash flows and then use it to find out your holding period return. And in some cases, what we also see is whatever the holding period return that is typically coming out, people do annualize that holding period return. Let's say you have got your holding period is 1 month, right? Let's say your holding period is 1 month and you have got a 1% return during the month. Generally, when it is annualized, we say 1.01 to the power 12. We find the effective annual yield and probably say 12.68% is the holding period return for this particular investment. Though you have got 1% in the month, we are generally annualizing this holding period return and presenting it as 12.68%. Here, the only thing that needs to be careful is this 1% may be specific to this particular month. In the other months, I may not get more than 0.5% or probably I may lose 0.5%. All these things are possible, but whatever I got in a month, if I am converting it into a year by simply annualizing it, it may either over predict or under predict the return, right? So that's one thing an analyst has to be careful of when trying to annualize the holding period return, because holding period may be the period maintaining the consistency across all the periods for that kind of a return is a challenging thing. So that is one more aspect that needs to be comfortable with while understanding the returns. Then the next concept that I would like to look at here is the concept of realized as well as expected returns. Historically, whatever the return that the particular stock has generated or particular asset has generated is what we call as realized return. Historical, based on the past data, if I am able to compute that in the last 1 year this particular stock has given 15% return, that is what we call as a realized return. And the same thing when I am projecting for the next period, based on the securities expected performance and based on the understanding of the business of that particular company, if at all a return is predicted, if at all a return or a price is predicted for the next year, for the next period, we call that kind of a return as expected return. So it is purely based on the analyst's expectations. It is not a past data. Probably based on the past data and various other factors are based on the understanding of the company's performance. If an analyst is able to predict the future price as well as the return in the process, that is what that kind of a return is what we are calling as expected return. Then another important definition of a return that is coming in is the required rate of return. Required rate of return is purely looked at from the perspective of investor. Expected return is primarily looked at from the perspective of the security. Security's performance. Then that is what is resulting in an expected return. But when I say required rate of return, what is that minimum basic return which the investor is expecting if at all he has to invest in this particular security? that is purely based on the characteristics of the given asset, understanding the risk behavior of this asset. Based on the risk behavior of the asset, what is the return? So the dimension is different. This is not based on the risk behavior. This is based on how the company is going to perform in the next year from the operations dimension. This is purely from the operations dimension. What is the kind of return that I can expect from this particular security? But when I am looking at the required rate of return, I am trying to look at it from an investment dimension, primarily associating it with the risk of the particular security. What is corresponding to the risk which this company is having? What is the minimum return that can be expected if at all I have to invest in this particular security? So if the particular security is highly risky, the return expectation, the required rate of return would be much higher, and vice versa. Because the other way to define the required rate of return is it's actually an opportunity cost. I am foregoing some other opportunities to invest somewhere else by trying to invest in this particular security. So what is the minimum kind of a return that I have to expect out of this particular security is what is defining the required rate of return. Generally, for making investment decisions, people try to compare the required rate of return with the expected return. So based on the investors' expectations versus the actual operation performance of the company. If the company's performance is better, the expected return will be greater than the required rate of return. Which means we can very well say, though the investor is looking for a return of RR, the company has generated a return of ER. So there will be a kind of demand for investment in that particular company. So those kind of securities are treated as underpriced securities, which will result in buy decisions by the analyst. Whereas when we see the expected return less than the required rate of return, it's a kind of a negative signal. The actual performance of the company based on its operation is much lesser than what the investor has linked to it corresponding to the risk of that company. So obviously because of the negative signal, it is treated as overpriced, and typically a sell recommendation will be given by the analyst. So if there is a huge buy recommendation given, the price of it is going to go up, which means the expected rate of return slowly will become equal to the required rate of return. Similarly here on the other side, if a sell recommendation is given, lot of selling will happen, which makes the price come down, which will result again in expected return will be converging to the required rate of return. So the buying and the selling process will continue until the expected rate of return is matching up with the required rate of return, and vice versa. So required rate of return is a very important concept as far as the valuation of the securities is concerned, or decisions or recommendations relating to the investment are concerned. Then other related concepts that we are supposed to look at as part of return is, one is a discount rate. Generally, we have used the discount rate in various contexts, even in our capital budgeting and various other scenarios. It is that particular rate of return which we use to find the net present value of any investment. It could be for a capital budgeting decision, or it could be for an investment decision. The discount rate is that particular rate of return that I am expecting in each of the years out of the investment that I am making, which will help me decide what should be invested as of today or if I am investing some X as of today, is that a profitable investment decision? So in short, it helps me in trying to compute the net present value of the investment. Depending on what are the cash flows I am considering for the future, because the discount rate is nothing but, generally in the valuation process we use the discount rate very heavily. In the valuation process we use the discount rate very heavily, whether it is the equity valuations or any other valuation. Typically in the valuation process we use the discount rate very heavily, and the valuation process is nothing but the present value of future cash flows discounted at the discount rate. Now what we are saying is, if the future cash flows are the cash flows of the firm, the entire firm generated cash flows, you discount them at weighted average cost of capital. But if the future cash flows which I am looking at are cash flows that are going to the equity investors only, means I ignore the cash flows which are going to the lenders, I look at the cash flows which are going only to the equity investors, then I discount it with the required rate of return, which I have just talked about. Whereas if I am discounting the entire company's cash flows, probably I am discounting it with the weighted average cost of capital, which is nothing but it includes the required rate of return of equity, but also includes the required rate of return associated with the debt. So especially if a company is having both the debt capital as well as the equity capital, so we are trying to find out what is the required return, not just for the equity investors but averaged across all the sources of capital. We may be having some debt investors, we may be having some preference share investors, we may be having some equity investors, and each investor will have a different required rate of return. So if I am doing an average of the required rates of returns of all the sets of capital suppliers to the business, weighted by the amount that they have supplied to the business, that is what we are calling as weighted average cost of capital. And what we are saying is, if the cash flows of the firm are considered, then discount that with the weighted average cost of capital to arrive at the valuation of the firm. If I am using only equities cash flows, discount the equity cash flows with the rate of return of required rate of return of equity, and arrive at the value of equity, not the entire firm. And one more thing is, if at all my cash flows are real, means inflation adjusted, even the discount rate needs to be inflation adjusted. If my cash flows are nominal, not adjusted for inflation, then even the discount rate also will be nominal. So these kind of things need to be understood from the perspective of the discount rate. Then one more aspect that we are looking at is the internal rate of return. That particular rate of discount which will make my present value of the cash inflows equal to the present value of the cash outflows, means at that particular discount rate the NPV is assumed to be 0. That will be equal to the required rate of return only in case of efficient markets, whereas in all the other cases it may be very much deviating from the required rate of return. So these are the various definitions of return that we have to understand, because we use different forms of returns in different contexts for different calculations kind of purposes. So understanding all of these will give a basic idea into the various forms of returns and in which context I need to look at what form of returns. Alright. The next thing which we are going to look at is the concept of the equity risk premium. So now we are moving slowly towards the computation of the required rate of return. Right, the slowly our objective is to move towards the computation of required rate of return for an equity investment. So moving in that direction, we are first trying to identify what is meant by the equity risk premium. Normally we know that investing in an equity market is more risky than investing in a risk-free security. Investing in a government treasury bill or a government bond, investing in equity market is more riskier. Now, how much more riskier? How much extra higher the risk that I am taking should result in higher return? So what we are trying to find out by using this equity risk premium is, now that I am ready to take an additional risk by investing in equity market per se, not any particular security. Now that I am taking an additional risk by investing in the equity market per se, how much additional return can I expect out of the equity market, or how much excess return is offered by the equity market compared to the risk-free rate? For taking that additional risk, how much excess return is being offered by the equity market in general? That is what we are calling as equity risk premium. Now that I know that, in case I know what is the equity risk premium, which means in general what is the excess return that I need to get by investing in the equity market, then I will get into a single security level, assessing the risk of that individual security with respect to the market in general. With market in general is average behavior of the equity market. So assessing each and every security with respect to the average behavior of the equity market, I can very well find out what is the return that I can expect for this particular security based on the assessment of the risk of the security. So that's where we say this, once we have found out the equity risk premium, I can use that information to typically measure the required rate of return that is necessary for each of the individual stocks, and for that I am using the beta. To a large extent we remember the formula also saying required rate of return on an equity security is equal to risk-free rate of return plus beta times the equity risk premium. RM minus RF is what is the equity risk premium, and based on the assessment of beta for that particular security in connection with the overall market return, we are trying to find out the return associated with this particular security. So here our focus primarily is, how do I find out this RM minus RF, which is nothing but the equity risk premium. Once I am able to have the equity risk premium RM minus RF, I will try to find out the beta of the security with respect to the market, which will help me in deciding what is the required rate of return for this particular security. And because this is purely an estimate, this RM minus RF sometimes may be a historical, but sometimes it may be an estimate, and that too if I have to find out the required rate of return, I am using it as an estimate, which means it may have realized or it may not have realized at all. And coming to what number do I need to use coming to what number do I need to use for equity risk premium, there are two major dimensions from where I can derive that RM minus RF. One is based on a historical estimation. So from the past data, choose one equity index which is a representation of the entire equity market. Choose one equity index. Probably I may choose a Nifty if I am in the Indian market, or I may choose a Sensex, or I may choose an index on Nasdaq, or I may choose an index on NYSE or Dow Jones. Some such kind of an index which is a representation of the broad market, broad equity market. Choose a time period, last 20 years or something like that. Choose a time period. During this period, find out what is the return that that particular index has resulted in, and at the same way find out what is the return on the US treasury bills or treasury bonds over that entire period. The subtraction between the two, because the treasury bills or bonds are assumed to be more or less risk free, and we are trying to find out the return of the market based on the broad equity index which we are choosing. The difference between the two for that entire period is what is giving me the estimate of average RM minus RF, which is easier to compute. But a couple of things that we need to understand in that context is that particular mechanism assumes that the return distribution is stationary. What do we mean by assuming the return distribution is stationary? It says if the return values are much higher, they come back to the mean. There is a kind of mean reversion that is associated with the returns. So if at all the returns are much higher now, they may come back to the mean. So overall mean is constant for a particular period. If I am taking over time, the mean and the variance of the returns is more or less constant. That is the assumption of this particular model. But in reality, it may not be the case, especially when the markets are booming. I may see that the returns are much higher. When the markets are falling, the returns could be much lower also. The same case will happen to the premium also, the RM minus RF also. The RM minus RF may be cyclical also. Right, it may so happen that when the markets are doing good, RM minus RF may be much lesser, whereas if the markets are doing very bad, probably RM minus RF could be much higher also. All these kinds of scenarios have to be understood better. It's not an average behavior that needs to be looked at. And we may also see that this particular estimation mechanism is prone to a survivorship bias also, because if I don't include all the firms which have been which got closed during this period, the returns, let's say, of the firms which started 10 years back but today they are no more operational because of non-performance and all, if I don't include all of them and if I am including only the survivor firms to find out the returns, historical return, then probably we are exposing our computation to survivorship bias. So whatever the RM minus RF estimate that I am going to get is more and more biased. And few more interesting aspects here. Okay, the mean return on a broad equity index. But do I need to use arithmetic mean or geometric mean, or what kind of mean? Because we know that arithmetic mean is always greater than or equal to geometric mean. So if I am using geometric mean, immediately RM minus RF is coming down. It becomes a conservative estimate. So what kind of mean I need to use? And what is that I need to use as a proxy for risk-free rate? Do I need to use the swap rate? Do I need to use a treasury bond rate or treasury bill rate? What is the rate I have to use as a proxy for risk free rate? All these things are challenges. So based on this challenges, we can still go ahead in terms of finding out some value for RM minus RF, so that it helps us in finding out what is the required rate of return that can be looked at on a typical equity security. So that is the historical way of estimating RM minus RF. We also have a forward looking, more of a futuristic outlook, otherwise we call it as ex ante. Historical is always called as ex post. So when we are using ex ante or forward looking kind of approach, all I am trying to do is I am trying to find out the premium RM minus RF based on the current values and future expectations of all these values. They are not based on the past. Okay, in future what is going to be the RM? In future what is going to be the RF? So I am trying to predict the RMs and RF and all these things for the future using various approaches, and then I am using RM minus RF, which means it is more of a futuristic or forward looking kind of estimate for equity risk premium. It's nothing based on the historical data. So there is no question of the assumptions relating to mean reversion or stationarity of the returns, and even there is no more assumption relating to survivorship bias. All these things will not be possible because we are trying to compute some values of RM minus RF for the future based on the current values and the expectations about the future with respect to each of those values. Then coming to that forward looking approaches itself, we are trying to look at three major kind of models. One is called as a Gordon growth model, which is also called as a constant growth model. So what it says is, you try to compute your RM minus RF using this particular process. You take a broad index, right? You take a broad index like a Nifty. So this broad equity index, you expect how much dividend yield can be coming up on that particular index, means how much dividend is going to be declared by the various companies which are constituting the Nifty in the next period, and try to identify what would be the dividend yield for the next period. So using some mechanism we are trying to forecast the dividend yield for the next period, and again using some other mechanism we are forecasting what would be the index value at the end of the next period. So which will help me in finding out what would be the growth in the index for the next period. So we are looking at dividend yield along with the growth in the index. These two together is an estimate of RM. So the dividend yield during the period minus the dividend yield during the period plus the change in index during the period minus the risk-free rate of return minus the risk-free rate of return. So the risk-free rate of return is what is coming from what do I think would be the yield on the long-term government bond, and the arithmetic here which is talking about the dividend yield plus growth rate in the index minus the bond yield, government bond yield, is whatever the value that I am going to get is what I am considering as RM minus RF. So this is purely based on the expectations for the future. How much would I expect as a dividend yield on the index? How much am I expecting that the index would be growing or falling in the next 1 year? And what is the typical yield that is expected on a long-term government bond? The difference between these things is what is going to give me the equity risk premium using the Gordon growth model approach. But as the name itself is saying, it assumes that the growth is constant across. Whereas what we observe is the growth may considerably change with the change in the economy. Probably during a very economically strong period, generally it is observed that dividend yields are much lesser because the companies want to retain a larger portion of their earnings and contribute to the growth. So the dividend yields would be much lesser, but it may so happen that the index growth rates are much higher, and at the same time even the bond interest rates also would be much higher. So which could result in the RM minus, because the bond yield is much higher when the economy is growing and much lower when the economy is falling. What we may see is RM minus RF may be much lower in case of growing economy, and it may be much higher in case of falling economy, which means we may have to adjust the values to reflect the state of the economy, and based on that consider them as a part of the equity risk. So the equity risk premium may not be constant forever, depending on the kind of economy right now we are operating in. The RM minus RF would be either higher or lower depending on whether the economy is in a boom or a bust kind of a period. The same way, the growth rate may not be a constant in reality. So sometimes people may look at this growth rate also. Okay, if the economy is rapidly growing kind of an economy, what is the kind of growth rate that I can expect? If I am expecting a mature kind of an economy, what is the kind? So depending on whether the country is more and more matured or rapidly growing kind of economy, again the changes in the growth rate would be different. So all these things I have to consider to finally arrive at my RM minus RF. So that is a challenge. But yeah, understanding on how do I arrive at RM minus RF is very important for us. Then the second set of forward-looking models which we generally look at are the macroeconomic based models, wherein we are trying to tie up the macroeconomic variables like the inflation or GDP growth or expectations of the price to earnings ratios changes, all these things which are more and more macroeconomic variables. We are tying them along with the index prices to finally say that this is the kind of excess which the equity market is expected to offer above the risk-free rate of return. So wherever a country is having an equity which is a large share of the economy, which is already a developed kind of a country, this model can be used quite effectively. One common model which we generally see as far as macroeconomic model is, we take three major factors. One is the inflation rate, which can very well be estimated based on the yield on treasury bonds minus equivalent yield on TIPS, treasury inflation protected securities. So whatever is the difference in the yield that is coming up, which is an indicator of the inflation rate during the period. So I'll take the inflation like that. I take another factor 1 plus expected real growth rate in the EPS. The real growth rate in the EPS, earnings per share, is growing. Earnings will grow on an average at the rate of GDP. So I can take GDP as one more factor, and expected change in the P by E ratios. Probably depending on whether the market itself is overvalued or undervalued, we are taking expected change in P by E ratio. If the market is per se itself is overvalued, then I expect that the P by E will come down in the future. So the expected change would be negative there. When the market itself is in is in undervalued kind of a position, I expect that it will go up in the future, so there could be a positive P by E change. So what we are looking at as a part of the macroeconomic model is, along with the yield on the index, which is the percentage growth on the index, we are also looking at integrating various macroeconomic factors, especially the inflation, the real growth rate, which is more linked with the GDP growth rate, and also we are looking at the expected changes in the P by E kind of ratios, along with the change of index. From there we are subtracting the expected risk-free rate. This is what is a model, one such model which we can use to predict the equity risk premium. So that is based on the macroeconomic factors. And the third set of model which can be used to find out the equity risk premium is a basic survey based estimate. So which is based on simple opinions, simply collecting the opinions from various experts in the equity valuation space. So depending on how much excess return over the risk-free rate of return suggested by various experts, we are arriving at one particular estimated value for RM minus RF. Easy to build, but different experts may give different kinds of expected values. So there could be a lot of disparity among the various opinions that are coming up. How do I handle those various opinions is a challenging thing as far as finding out the equity risk premium using the survey estimate kind of a method is concerned. So this is what we have to understand and appreciate as far as computing the equity risk premium is concerned. We can use any of these mechanisms to typically understand and compute the equity risk premium. And further, once we understand the betas and various other aspects, we can very well get into the computation of the required rate of return for a typical one single equity investment. Alright. So now we have to start discuss. Now that we know RM minus RF and the computations of RM minus RF, now we will proceed towards the various models which can be used to estimate the required rate of return of equity itself. So we talk about different kinds of models which can be used to find out the required rate of return on equity using this equity risk premium as the input. Alright. Now looking at various approaches to finding out the required rate of return on equity, we start off with the more traditional capital asset pricing model, CAPM, wherein our intention is to identify the required rate of return on the security based on the risk-free rate plus the beta times the equity risk premium. A very traditional method, but of course as a benefit it is easy to compute, because I can, once I find out the equity risk premium and compute the beta, only one major factor, it is assuming that the risk return of the security is purely based on the return of the market. Only market is the factor that is playing a role in terms of identifying the required rate of return of the security. So easy to compute, but that itself is a kind of a limitation. There could be various other factors which can impact the return on the security, not just the market. So this is in the industry circles, this is called as the single factor model. Easy to calculate, but at the same time has its disadvantage, because it is considering that the market is the only factor that is playing an important role in determining the return, the required rate of return of the security. An extension to this CAPM is done by various multi-factor models, where the explanatory power is improving. Here everything I am looking at in terms of the equity market itself. Whereas when I am looking at a multi-factor model, I am considering multiple risk premiums, and each risk premium is taking into consideration various risk factors. Right, I am considering various risk factors, RF1, RF2, RF3, RFN is considering various risk factors, and to what extent our security is sensitive to each of these risk factors. We are considering various risk factors. These could be from a macroeconomic kind of perspective. We are considering various risk factors. Let's say this could be inflation, this could be GDP growth, this could be various other factors, right? Each of them could be a separate factor, probably the change in the P by E ratios. All these various factors we are considering, and we are looking at the sensitivity of our particular securities return to each of these factors. So because we are considering more and more factors, it may so happen that the explanatory power is much higher, because this is being looked at as a simple regression model, whereas this is looked at as multiple regression model. There is a very high possibility that the R squared or adjusted R squared will be higher in this model compared to in this model, though not mandatory, but there is a good chance that the R squared will be higher in this model compared to this model. So that's where we use the word saying explanatory power is much higher when it comes to the multi-factor model. But yeah, it is looked at as, it is perceived as being a very complex model, because identifying the various risk factors and finding out the security's sensitivity to each of these risk factors is very difficult. And the way we are trying to find out all these risk factor premiums, just like an equity premium, see, it's basically like, it's better to look at it on the same lines. RF plus beta 1 times RF1 minus RF plus beta 2 times RF2 minus RF, sorry, risk factor. When I say RF here, risk factor 1, risk factor 2, beta 3 times risk factor 3 minus the risk free. All these things, these are the premiums associated with each of the risk factors. Assuming that this is the only risk that is present and all the other risks are not present, other factors are not present, giving a beta of 1 here to this, what is the RF3 minus RF that is coming out? That is what I am taking as the premium associated with each of these risk factors. Now that I have identified each of these excesses, each of these risk premiums, we are ending up finding out the values of each of the betas. So it is in a way looking like a very complex model, and at the same time a very time and cost and effort consuming kind of a model. So though its explanatory power is much higher, it has limitations from this dimension. So that's where it needs to be understood and evaluated more and more in a cautious kind of a manner. Then a slight improvement over the multi-factor model is the Pharma French model. Instead of leaving all these risk premiums to the analyst, instead of just saying you consider as many risk factors as possible and sensitivity of your securities returns to each of these risk factors, So wherein which risk factors to identify, how many factors to identify, all that is up to the analyst, is left to the analyst, is left to the imagination of the analyst, because this is purely a framework, nothing more than that. But Pharma and French model has gone a little bit deeper in terms of understanding the multi-factor model and came up with only three different kinds of risk premiums. One being said as equity risk premium, which is same as the CAPM kind of a model. So RI, they said RF plus beta 1 times RM minus RF. So this is what is a simple CAPM kind of an approach, but towards the two they have added two more things. Small cap premium. So probably it's like saying R small minus R big, which is nothing but they went with an assumption saying small companies generally provide a better return compared to a bigger companies. So this R small minus R big is typically arrived from the perspective of take the average of all the small companies' returns. You first classify the companies as small and big. You take the average return of all the small companies, average return of all the big companies, and the difference between the two is what we call as a small cap premium. Because the company is very small, the return will be slightly higher for smaller companies compared to the larger company. So R small minus R big is considered as one more variable, which is against which we are trying to find out the sensitivity of our securities returns with respect to that particular difference also. So beta 2 is primarily identifying the sensitivity of our selected securities return with respect to the difference between the small company's return versus the large company's return. That difference is what we are calling as small cap premium, and we are trying to find out the sensitivity of our particular securities returns with respect to those set of return. Then similarly, the third element which they have highlighted is the value risk premium, otherwise called as return of high market to book value companies, market to book value ratio higher. The return of high book to market value. High book to market value ratio minus the returns of low book to market value. What does it mean? High book to market value is nothing but it is an indicator of undervalued companies, right? The other way is book to market value is high means market to book value will be lower. Because it's a reciprocal. Market to book value lower means price to book value ratio is much lesser. Price to book value ratio much lesser is an indicator of undervalued companies. So find out the returns of all undervalued companies and the returns of all overvalued companies. What it is saying is the return of your security is sensitive even to the difference between the returns of undervalued versus the overvalued companies. So what the Pharma French model was suggesting is consider these three groups of data. One, apart from the equity risk premium which is being considered by the CAPM model, we will also consider two additional risk factors, which is a small cap premium, which is the return of small companies minus the big companies. Similarly, high book to market value companies minus the low book to market value companies, and try to find out the sensitivities of each of sensitivity of our securities returns towards each of them. So it is like the base value, the beta 1 is generally assumed as 1, which means beta 1 equal to 1, the risk premium, the market the securities market risk is same as that of the market. Similarly, on an equilibrium basis, beta 2 is expected to be 0, which means the security is not that much sensitive to the difference between the small and the large. Similarly, even for this, the beta 3 is also assumed to be 0, if at all we are talking about a neutral kind of a security. But if the security is very small, probably the beta 2 will be positive. If the security is is under a high value kind of a security, which means high book to market value, then even then you will find that the beta 3 will be positive, otherwise they are going to be negative. So once we know these particular numbers, R small minus R big, R high book to market value minus the returns of low book to market value kind of companies, and the sensitivity of our particular security with respect to each of these three numbers, we can very well apply the Pharma French model to find out the expected rate of return on our security, which means you can very well say that this is an extension to the CAPM model, because the CAPM model RI equal to RF plus beta times RM minus RF. Until here it's the CAPM, but this particular model adds a little bit more in terms of R small minus R big, along with beta 3 times R high minus R low, book to market value. So if both these betas are positive and both these returns are also positive, we may see that the expected return of our security is higher than what is being predicted by CAPM. If the betas are negative, we may see that the return that is prescribed by our security is lower than what is being identified by the CAPM model. So this is an enhancement over the CAPM approach. Then coming to the next model, which is a Pasteur-Stamba model. It is exactly a Pharma French model, but a small extension. Even a beta 4 is being considered as a part of Pasteur-Stamba model, multiplied by its liquidity risk premium. The liquidity risk premium, again the same, because the Pasteur-Stamba model made an assumption that even liquidity plays an important role in deciding the expected, the required rate of return on that security. Less liquid securities typically require more return than the more liquid kind of securities. So that's where the returns of, again it is taken, the returns of less liquid securities, the returns of more liquid security minus the returns of the less liquid securities is being considered, and the beta for the same is being looked at. The beta is positive if this is less, because it is expected that the less liquid securities give a more return compared to a high liquid securities. So when we are looking at the beta, if our security is less liquid, it will have a positive value, and if it is more liquid, it will have a negative value. So Pasteur-Stamba model is slightly an extension over the typical CAPM and the Pharma French model, even considering the liquidity risk premium as well as the sensitivity of the security with respect to the liquidity risk premium. Then we have in the multi-factor model itself. These are all multi-factor models. In the multi-factor model, purely based on macroeconomic, wherein we consider various macroeconomic factors which can impact the cash flows of the company. You can use various macroeconomic factors and their sensitivity of our security with respect to each of those macroeconomic factors to finally identify what is the expected rate of return on the security. So that those factors could be more or less with respect to time horizon, inflation, business cycles, any of the risks associated with any of the macroeconomic factors also can be looked at. Then there are one more group of models called as build-up models. The build-up models, they are more or less similar to any of these methods itself, but the only thing is they don't go with the betas. They simply add up the various premiums, and based on that they arrive at the required rate of return. So there is no beta, no sensitivity, so becomes easier to compute. All these models will become more and more easier to compute because there is no question of beta, no question of finding out the sensitivity of this particular securities return with respect to the overall return. So that's the reason we generally apply this mechanism for companies where betas cannot be predicted directly, means either private companies, not public listed kind of companies, or companies which are thinly traded in the market, wherein the beta is not that easy to compute, and even if it can be computable, it cannot be reliable. In those kind of scenarios, we depend very heavily on the build-up kind of methods. One of the most common build-up method which we use for finding out the return on the security is bond yield plus a risk premium method. Let's say if this particular security has issued a bond with an yield of 8%, and I am assuming historically that the risk premium, let's say, is around 5%, which means generally overall we have seen that the equity markets are giving 5% more return compared to the bond market. So I find out the yield of this particular security and add a risk premium to it without doing any beta or any kind of calculation. We are saying that the required rate of return for this particular security, let it be around 13%. So that is how we use the build-up method models. So any kind of premiums we just add up and finally say this is the required rate of return. We don't bother too much into computations of the sensitivities and all these aspects when we are dealing with the build-up method, build-up models. So just as a comparison between these various models, on a quick note, we see that the CAPM is easy to calculate but does not have that much of explanatory power, and because it's a single factor, especially if a security is listed on multiple indexes, and if I have to take multiple indexes as factors, it cannot allow me to take them, so I am restricted. Or if I am taking different models for different indexes, the different returns can come up, but for a security I cannot have different returns just because it is listed on different exchanges. So even from that dimension, CAPM loses its flexibility. And when it comes to multi-factor models, though the explanatory power is very large, though multiple factors can very well be used, but as we have already discussed, they are very complex to build and they are pretty much expensive. So whether it is Pharma French model or a Pasteur-Stamba model or any macroeconomic based multi-factor models, all of them are quite expensive to be built. And when it comes to the build-up models, yes, they are good because they don't consider too much of betas and sensitivities and all those things, and they can be very comfortably used for private companies, but the data may be very much stale, heavy dependence on historical values. I cannot get into the futuristic values at all using that particular mechanism. So there are limitations associated with each of these models from that particular dimension. Now that we know the various models that are associated with computing the required rate of return on the security, the next thing we are getting into is identification of the methods for computing beta of the security, because beta is one of the important factors that is going into the CAPM model as well as the various multi-factor models. Except the build-up models, all the other models have a dependency on beta. So in what ways we typically look at the beta, which can go into the estimation of the required rate of return, we'll be looking at in our right now. Right now we will get into looking at the estimates of beta for the public as well as private companies. In what way I get into the estimation of the beta process. So now looking at estimation of beta, we differentiate between the beta for a public company versus a private company. So whenever we look at the public company, our approach is quite straightforward. We look at, whenever we are looking at for a public company, we are typically looking at a simple regression of the particular securities returns over the market returns. So we take the securities returns probably daily or monthly or something for the last 1 year or 2 years. These are all specific to the analyst. Should I take daily returns or monthly returns or weekly returns? For what time period do I need to take? But yeah, securities returns are taken, and for the same periods I take the index returns, do the regression of this over this. Whatever the slope, so this will be my independent variable. The index returns are the independent variable, stock returns are the dependent variable, and whatever the slope that comes up is what is being defined as a beta for a public listed company, right? So the slope of the regression between the securities returns over the market returns is what is the definition of beta. But the biggest problem is what index need to be taken, for what time period the securities returns and the market returns need to be looked at, and what is the frequency of the data. Should they be daily returns or weekly returns, or what needs to be taken. All these will become the challenges, but the analyst has to make some kind of assumptions regarding each one of these and try to come out with one estimate of beta for that particular security. And that beta is primarily a historical beta. So that's where, in case the focus is to go with the forecasted beta, we always talk about the concept of the adjusted beta approach, which is nothing but, this is based on the assumption that the beta will follow a mean reverting process over time, and it fluctuates around 1, which means if the beta is somewhere way above 1 in a particular period, it may come back to 1. If it is below 1 also, it may go up to 1. So based under that particular assumption, it is getting worked out that the adjusted beta, we generally first take the regression beta, give a 2/3 weightage to it and 1/3 weightage to 1, so that the beta approaches the 1, as it is a kind of mean reverting kind of a scenario. So though we take the regression beta, we don't consume it as it is. We try to make some kind of an adjustment to that regression beta for the estimate. If we are looking at a futuristic estimate of the required rate of return, we first do an adjustment to the beta by multiplying the regression beta with 2/3 and 1 with 1/3 to finally arrive at the adjusted beta, which can be used as an input into the CAPM or any other required return estimation kind of models. But in case we are coming across a company which is not publicly listed, or which is purely thinly traded, though it is listed, the stocks of it are not traded that heavily. For those kind of companies, if at all I have to find out the beta, we go one step further and do a method called as a pure play method, wherein the process is like this. First, I identify an equivalent public traded company. So though, let's say we are talking about a privately listed cement manufacturing kind of a company. So what I would be doing, the first step is, if I have to find out the beta for that particular private company, I would first identify an equivalent public listed company which is more or less into a similar kind of business. So that is the first step, and for that particular company I would try to find out what is the beta. I cannot directly use that beta for this private company because the capital structure of both the companies could be different. That particular public listed company might be 70% equity and 30% debt, whereas the current private company may be 30% equity, 70% debt. So the beta, the expectation is the beta will differ based on the capital structure as well as the marginal tax rate. So once I have found out the beta of that public listed company, we try to unlever that beta. What is that unlevered beta? Forget about the capital structure. Forget about the capital structure, removing the impact of the capital structure, and even the marginal tax rate, I would like to find out what is the asset beta. So that is what we call as the unlevered beta. So the asset beta, what will I do? Whatever the beta that I got, I multiply it, right? Whatever, see, basically let me put it like this. The unlevered beta is equal to weightage of debt into beta of debt plus weightage of equity into beta of equity. Now weightage of debt, how will I get? Debt by debt plus equity, and generally the debt I have to take it as post tax, into beta of debt generally is 0 because the beta is about the risk, and for a debt capital the risk is not existing because the fluctuations and all may not exist. So generally we don't consider this portion at all. So the weightage of equity will become equity by debt into 1 minus t plus equity, that is the weightage of equity, into beta of equity. So we have found out the beta equity for that particular security. Now what we are saying is, when I am unlevered, I am finding the unlevered beta, all I am taking is, I am taking the equity beta, you get this down. So E by E is 1, 1 plus D by E times 1 minus T. The debt to equity ratio multiplied by 1 minus T. So for this company the debt is 30%, equity is 70%. So whatever the equity beta that comes out, all I can say is 1 plus 30 by 70 times 1 minus T. This is what is my unlevered beta. So what we say is, once I compute this unlevered beta, I will equate the unlevered beta of the public company with the private company. The unlevered beta level I equate for both the companies. So once I get the unlevered beta for the private company, I would even incorporate the capital structure as well as the tax rate for the private company, and again find out the levered beta, the equity beta for that particular company, using the same reversal approach, right? Only the debt to equity ratio and the tax rate of the private company are considered to finally arrive at the equity beta for this private company. And once I have the equity beta, that I will take into the CAPM or any other cost of equity required rate of return estimation models to find out the overall required return for a private company or thinly traded public listed company. Then one more aspect that we are looking at in this particular session is, what if my equity is having international investment? What if I am trying to look at international investments as a part of my investment? So the international investments have some kind of impact with respect to the changing exchange rates. So the model which we are trying to consider should take into consideration the expected changes in the exchange rate, and the required rate of return needs to be updated for the changes, expected changes in the exchange rate. And also, depending on the country which I am investing in, a developed country investor investing in an emerging or a developing country, there should be some kind of an adjustment that needs to be made towards the emerging market kind of a risk. So some kind of return adjustment, especially targeted towards emerging markets, also need to be looked at. For this, finding out that excess premium associated with emerging markets, it is understood that we can go with one of these two models. One is a country spread model, which will identify the excess return towards the country specific risk. So there is a country spread model which says, okay, you take the developed countries risk premium, or probably the required rate of return if it had been a developed country, and add a premium for the emerging market. And the way people are saying to define the premium is, find out the bond yield in the emerging market minus the bond yield in the developed market. So whatever is the difference between the typical government bond or even this particular bond yield itself in the emerging market versus the developed market, whatever the difference that is existing, consider that as the premium and add it to the return which you have initially expected, which you have initially estimated, assuming that this particular country is a developed country itself. This is one way we can use the country spread model to typically find out the required rate of return. The other is a country risk rating model, which is a kind of a regression based model. What this says is, you take the equity risk premium of the various countries and their corresponding risk ratings, especially for the developed countries. For the developed countries, you take the equity risk premium and their corresponding rating. Let this be the dependent variable, let this be the independent variable. Based on this, find out a regression equation. Now, use this regression equation and identify the ratings of the emerging markets, emerging countries. So now substitute the ratings of the emerging markets and find out what should be the equity risk premium that is associated with this emerging market. Use that equity risk premium of the emerging market in terms of finding out the required rate of return for the securities in the emerging market using a CAPM or multi-factor or any such kind of models. So these are the various aspects associated with the basic concepts of returns and how do we typically get into the process of computing the required rate of return using the betas, using the equity risk premium, and also taking into consideration the international scenario to find out the adjusted return based on the country specific risk. I hope all these things that are discussed in this chapter are comfortably understood by you. In case you have any further queries regarding this, you can very well get back to me by giving me a call on the number that I have provided below. or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.